December 2024, without a press conference, without a speech, without a warning, America's total debt quietly crossed $36 trillion. No headlines, no emergency meetings on TV. But buried inside U.S. Treasury statements, something far more dangerous appeared. Because this isn't just more debt. This is the exact moment America entered the third debt supercycle. A phase so extreme that every previous financial rule stops working. And once a country enters this phase, history shows there is no painless exit. Let me be clear. America has had debt before. America has had crises before. But $36 trillion is not normal debt. At current interest rates, the U.S. government is now paying over $1 trillion per year just in interest. That's more than national defense, Medicare, or any single federal program. America is now borrowing money just to pay interest on old debt. That is the textbook definition of a debt supercycle. A debt supercycle isn't a recession. It isn't a crash. It's when debt grows faster than GDP, interest costs grow faster than tax revenue, and monetary policy stops working. According to Federal Reserve data, U.S. debt to GDP is now over 123%. Historically, every country that crossed 120% entered systemic instability. Japan, Italy, Weimar Germany, different eras, same ending. This is not America's first debt supercycle. First, 1940s, W2 debt explosion, solved through inflation plus financial repression. Second, 1970s, 1980s, oil shocks plus stagflation, solved through brutal rate hikes and recession. Third, now but here's the problem. This time rate hikes are mathematically impossible. At today's debt levels, if rates rise just 1%, interest costs jump by $360 billion per year. That single move would blow up the federal deficit, force emergency borrowing, trigger Treasury market stress. That's why the Federal Reserve is trapped. They can't raise rates. They can't cut spending. They can't default, which leaves only one option: inflation. Not the headline CPI number, not the official inflation, but silent inflation. Currency dilution, asset inflation, purchasing power erosion. The Federal Reserve doesn't need inflation to explode. They just need it to stay slightly above interest rates, year after year. That's how debt dies quietly, and savers pay the price. In the 1970s, debt was low, demographics were strong, productivity was rising. Today, debt is extreme, baby boomers are retiring, productivity growth is slowing. According to Congressional Budget Office projections, U.S. deficits will exceed $2 trillion annually within this decade, even in a strong economy. That means permanent crisis mode. Watch the Treasury auctions. Foreign buyers, China, Japan, are stepping back. Primary dealers are absorbing more issuance. The Federal Reserve is quietly stabilizing volatility. When bonds stop behaving, currencies follow. This is how confidence breaks. Not overnight, but gradually. The U.S. Treasury must refinance over $9 trillion of debt by the end of 2026, at higher rates, with weaker demand. In a politically unstable environment, every rollover increases pressure. Every auction is a stress test. Here's what history tells us always comes next in a third debt supercycle: persistent inflation, currency debasement, financial repression, capital controls eventually, wealth transfer from savers to debtors. This doesn't happen in one crash. It happens slowly, quietly, and deliberately. The third debt supercycle isn't coming. It's already here. The $36 trillion line wasn't symbolic. It was structural. And from this point forward, every policy decision will be about one thing only: buying time. Because once a nation enters this phase, history shows there is no clean exit.